All right, what we're going to do here is looking at 9.8a. This is going to be a refresher from Accounting 1, especially dealing with the horizontal financial model, moving the temporary and permanent accounts to the T accounts, and then closing everything out from there. We start with event number 1. Company started by receiving $60,000 cash from the issue of common stock. As you can see, common stock goes up assets as well as equity, and it's a financing event. Now, for those of you who need a refresher on the statement of cash flow, remember there's 3 components to the statement of cash flow. There's financing, investing, operations. Financing, investing, operations. So when you're working on the statement of cash flow, get the horizontal financial model put together first, and then look at the cash flow. And this is what you know that's going to go on the statement of cash flow. Cash is going to go up from financing. Cash is going to go up from operations. Cash is going to go down from operations. Cash will go up from financing, down in operations, down in operations, down in operations. And that's what your statement of cash flow should look like. So then we're going to move on to a few of the more complicated ones here. If we look at 3A for a second. We sold merchandise for $220,000 cash, not included sales tax. Sales tax of 8% is collected. So we know that it's going to be sales tax, and you create a liability because you have to pay the sales tax liability. So what happens is assets go up because you sold some product, liability goes up as well as equity, and revenue goes up as well as net income because you're booking everything as revenue and net income, and cash from operations obviously goes up. Now you're going to book the expense component. Assets go down because you sold some product as well as equity. Expenses goes up and net income goes down. Now this is product you already paid for, so nothing's going to happen in the statement of cash flow. We look at number 4. And if we look at number 4, provide a 6-month warranty on the merchandise sold. 6-month warranty on the merchandise sold. And if we scroll down to, I have the page marked for you. Actually, if we go back to 3 for a second, please. If you look at number 3, please reflect back to page 480. 480. We'll go. If you look back at number 3 for a second, please. Go page 480, and that's going to walk you right through it. That's going to tell you exactly how to do it. Now, getting back to number 4. Number 4, we're going to go to page 483. 483. So if we look at page 483, what you're going to see here is recognition of warranty expense. Recognizing this obligation increases liabilities and reduces stockholders' equity. So it's going to increase liability and reduce stockholders' equity. And it's increased expense, and net income goes down. The statement of cash flow is not affected when the obligation and corresponding expenses are recognized. So then you book it like this. Liability goes up, net equity goes down, expense goes up, net income goes down. And then we want one last one here, I believe it is. Number 6. Number 6 talks about borrowing cash from a bank. This should be quite familiar to all of you. Cash goes up as well as liabilities. When cash goes up, $40,000 goes into the bank account. At the same time, your liability goes up. There's no revenue or expense item, nothing on the income statement. It's a financing activity. Cash flow does go up. Now, number 7. You paid $6,600 for warranty repairs during the year. Cash is going to go down, and you've been carrying a liability, and that's going to go down as well because it's reducing the liability. You're reducing cash, you're reducing liability. The balance sheet stays in balance, and operations activity is going to be reduced as well. Now we're going to get into the T accounts. What you're doing here, let's start with the general journal before we move to the ledger. These are all the transactions right here. This is how it's supposed to look. Cash goes up, common stock goes up. You buy $160,000 of merchandise inventory on account. It's an asset. This is a liability because you haven't paid for it yet. This is page 480. You want to follow that. You collect $237,600. $220,000 times 8% sales tax. Sales tax payable is the liability, and you book that as a revenue. And this is how you're reducing your inventory. Cost of goods sold, $140,000, as well as merchandise inventory. And this is the warranty expense right here, $8,800 because it's 4%. 4% of merchandise sales. And then when you sales tax payable, you pay off some sales tax, so you are reducing a liability and reducing cash. So you're reducing a liability and reducing a cash asset. And you're taking all these transactions and you're putting them into the T account form. Okay, you're putting them into the T account form right here. This is what the T account's supposed to look like, just like this. So then, we're going to try to prepare an income statement, balance sheet, and statement of cash flow. Remember the difference between the temporary and permanent accounts here. Temporary and permanent accounts. Temporary accounts close out at the end of the year. Permanent accounts carry over. We are going to start with the income statement. Sales revenue, cost of goods sold. And I'll go back up here for a second. Sales revenue, cost of goods sold. Sales revenue, that's how we got it. And the cost of goods sold, that's how we got that right here. So sales revenue is it. Give me a second. Sales revenue is right here. $220,000. Cost of goods sold right here. Now we're going to look at operating expenses and warranty expenses. Operating expenses and warranty expenses. Warranty expenses, operating expenses. Now, if you notice, we have some we're going to have one last item on here, which is interest expense. Interest expense is going to be the final component, and it's right here. That's transaction number 10. Record accrued interest at the end of the year. And if you look at number 10, the corresponding account is going to be interest payable. Right here. So here, the interest expense at the end of the year, interest payable right here. So that takes care of the income statement. Now we're going over the balance sheet. And all you're doing is moving the permanent accounts onto the balance sheet. So you're taking the cash, merchandise inventory, that's the total assets, adding up all the liabilities, $61,000, common stock, retained earnings, so that's going to give you You take total assets, assets equal liability plus equity, 130,600. Then you take 69,400 plus 61,200. I'm adding up the liabilities plus equity. 130,600. Everything balances out. Now you're moving into the statement of cash flow. And remember the trick I showed you earlier. Just go back to the horizontal financial model and show you what's coming in and what's going out. Take all the operating activities first. Cash comes in from selling the $220,000 in product. And then you took some cash in from sales tax. Even though you had to pay it out for a liability, you took cash in from sales tax. Outflow for inventory. Cash went out for inventory. Outflow for expenses. Outflow for sales tax. So the net cash flow from operations. So just go back to the horizontal financial model and you'll see each one of these right here. And 10,600 is cash coming in from operations. There was no investing activity. There was financing activity. Because remember with transaction number 1, you sold $60,000 in common stock. And in transaction number 6, you borrowed $40,000 from a bank. That gives you $100,000 in financing. So the net change in cash was $100,000 plus $10,600. Beginning cash balance we're assuming is 0, and the ending is $110,600. Then it says for D, what is the total amount of current liabilities? You're adding up all these liabilities right here. That's all you're doing, okay? Adding up all these liabilities right here. And that should get you through 9.8a. What I encourage you to do is follow this video while you're reading the textbook and looking at your own work, and it should make perfect sense. If you're still having questions, please post it back in the class discussion so we can keep reviewing it. It's important that you get a firm grasp of this concept before taking the midterm exam. That way you know everything. Thank you for your time.